All right, good afternoon, everyone. Thank you for joining today's afternoon's webinar. Okay, today we are happy to invite our guest speaker, Mr. Bruce Chang from Seesaw Asset Management, to give us this webinar with the topic, Can S-REIT leaders tide through the market turbulence? Okay, a bit of background about Mr. Bruce Chang. Mr. Bruce Chang is the head of fixed income at Seesaw Asset Management. He's responsible for the portfolio management of bonds, REITs, and money market instrument strategies. Before that, Bruce also worked at Sixth Street Global Advisors and held several roles, including product engineer, portfolio specialist, and portfolio manager. He was responsible for managing billions of fixed income portfolios across multiple sectors. Okay, with that, I shall pass it to Mr. Bruce.
Yeah, sure. Thanks, Daniel. And good afternoon, everyone. Thanks for attending today's webinar during the lunchtime. And today, our topic is CSOP IH S-REIT Leaders Index ETF. We're going to talk about its investment opportunities, particularly when the interest rate turn again. And interestingly, our investment advisor, they did give a very similar session during the Philips physical session in the Singapore Swimming Club 2 weeks ago. So for those didn't attend, or for those who would like to understand more about the S-REITs investment using the ETF vehicle, today it's a good time. And if you look at these charts, we have introduced these S-REITs headwinds and tailwinds chart back to 3 years ago. Now, if you look at the right-hand side, most factors have been moved in line with our expectations, such as the peak of inflation, peak of the borrowing cost, and also the at least early signals of a more friendly monetary policies from the US Fed, as well as the Singapore MAS. However, if you look at the top right, there is one factor still against our expectations, which is the economic growth, partially attributed to the global tariff war. And even Singapore is not immune. For example, the MTI has already narrowed this year's growth forecast by 1% to 2%. And on a forward-looking basis, the business sentiment has also weakened. And more importantly, the front-loading exports to the United States by Singapore and also its regional peer countries also imply that we perhaps just start to feel the pain of the tariff uncertainties second half this year. Of course, we can argue that Singapore has the lowest US tariff rate, which is 10% in ASEAN region. But given the high value added to the US imports, the Singapore is still vulnerable to the slowdown in the exports to the United States. But on a positive note, the inflation is definitely easing, and partly due to the cooling core inflation, and except for the transportation, and also thanks to the moderation of the labor cost. And additionally, there is enough liquidity if you look at the middle bottom chart. This is indicated by the low non-bank loan-to-deposit ratios, so we don't have any liquidity problem. And also, according to the CT estimates, on the top right, the year-to-date, the MAS has perhaps already reduced its SGD near slope by 100 bips. So as a result, the short-term Singapore rates, as shown on the bottom right, have gone lower already, which is diverging from the US rates, which is high for longer, at least in the near term for the US. And regarding the Fed, even there are some different opinions or outlook on the numbers of future cuts. It is still likely that Fed will anyway restart its cut second half of this year, maybe September or maybe November, December. So if that scenario really happen, and MAS also follow a very similar easing pattern, then the offshore earnings dilution from the previous stronger US dollar will finally dissipate and support those S-REITs with the large overseas revenue exposure, because even S-REITs are listed in Singapore. On average, they have 40% overseas revenue source. And even before the next rate cut, the S-REITs cost of debt has already peaked even almost back 1 year ago, which means the new debt raised by the S-REITs is already at lower costs, or even 250 bips lower versus its 3 years, the 2023 high, 2022 high. And S-REITs debt to asset level is also quite stable at around just 40%. And thanks to the rental growth and also their cap rate stability. And this year's MAS relaxation on the interest rate coverage ratio, the ICR, also provides further relief on the leverage pressure. For example, now, as shown on the dashed line, 45% gearing limit is applicable to the S-REITs with ICR less than 2.5 multiple, and 50% limit is applied to the S-REITs with ICR larger than the 2.5 multiple. And in addition to all of this, the positive asset yield carry is also constructive for the divestment. So in other words, the sold prices are higher than their S-REITs purchase prices for the same commercial properties, almost for almost all sectors across the regions in the world. So these could help the S-REITs build a healthier balance sheet and also encourage more acquisitions and the asset enhancement initiatives after the divestment. And fundamental wise, the rental reversions can still support the income growth. For example, as shown on the bottom, the top left, the retail rates, the first quarter reversions are still double digit on average, despite the diverged shopper traffic and also the diverged tenant sales among the different retail rates. And office rates on average also have a high single digit reversions, and so as to the industrial rates. And in contrast, the hotel rates, their RevPAR, is still suffering. And this is not totally out of expectations given their high room rates, perhaps the highest in the world. But the good news is that the fundamental challenges, they have been priced in a lot in the major S-REITs earnings reversions, such as the CIC, the Capital Land, the Freezers, or Mapletree, and even the Capel. But the implication here is that even it takes some time for earnings to recover, maybe not likely in the second quarter. But if interest rates start to turn again later this year, it is sufficient to trigger another round of the price rally of the S-REITs. And current valuation can also provide some boost to the S-REITs prices. Historically, when S-REITs were traded at 0.8 to 0.85 multiple PB, it would typically get a very strong support. For example, in 2020, in 2023, and also in 2024. So they repeat from time to time. And now S-REITs PB was just at 0.87, and as of yesterday, 0.89. So it's still at a low range of their historical PB. So based on this PB level, the price downside is quite limited, but upside potential is still highly great. And if you look at this yield page, and I think it's even more straightforward, the 6% plus yield, as indicated by this dark blue line, and over 4% yield spread, the normal blue line, they echo the attractive PB valuation. And this 4 plus spread level is actually the widest versus the Singapore 10-year risk-free yield since 2022. So because in the past, we always talk about, okay, dividends high, and a lot of investors come back saying that, okay, yield is high, the spread is not quite attractive, only 200 bips or 300 bips wide. But now it's 400 plus wide. So it's quite, the pickup is quite decent for now. And the recent 7-year spread versus this risk-free yield also gave the similar conclusions because if it's traded above this 7-year trending line, it implies now the S-REITs, their valuation are cheap. And even across the region, when comparing the 4.1% spread to the REITs in other markets, it still remains really attractive, and particularly versus the US and also the UK REITs. And since the rate cut expectations began at around 9 months ago, we have to say that S-REITs have underperformed most of their peer REITs in the world. Part of the reason is because of the fundamental challenge, and part of the reason is because of the at least at that time, the high Singapore rates, Singapore interest rates. But now it seems fundamental wise, Singapore is relatively defensive versus other economies, and also from a interest rate perspective, even without further Fed cut, the Singapore domestic interest rate has already gone lower. So if we combining these two factors, we have a good reason to believe that the S-REITs will catch up soon when the interest rates are turned again. And another interesting factor is more linked to the Singapore stock investors. This is the performance gap between the S-REIT and SRT, particularly not SRT, the Straits Times, and also the Singapore financial stocks. If you look at that chart, the underperformance have been already accumulated to 50% versus the Straits Times index, or even to 66% versus these the Singapore banks since 2021. This is mainly because of the previous high interest rate environment, which typically benefits these the bank stocks. But once the interest rate turns, these gap should narrow or even reverse. And in terms of sector outlook, we like to more on the to elaborate is more on the supply demand perspective. For example, for the industrial REITs, the supply demand is still manageable, except for some business parks and some factories, and these supports a generally positive average industrial rental growth in Singapore. And as for some office REITs, of course, if you look at the chart in the middle here, there is an increasing supply in the next couple of years, but the net supply is still below the 10-year historical net demand. So this also supports a Singapore private office space, especially the grade A rents in the central area, which means regardless of the economic cycle, there are always winners who would like to rent the grade A CBD offices. And similarly, the retail net supply is below 10-year historical net demand. And more encouragingly, both the Orchard malls and the suburban malls, their rents are rising in recent quarters. And even for the hotel REITs, because we are talking about their RevPAR pressure, they have a bottom line because Singapore visitor arrivals are expected to reach around 17 to 18.5 million in 2025, which is up to 3 to 12% year over year. So which means the downside is still relatively limited for the hotel REITs. And page 23 is actually our ETF's benchmark. The SGXIH S-REIT Leaders Index. It includes the 21 largest and most liquid S-REITs. Here, I don't want to read these the key numbers criteria, but the net result of this liquidity and also the trading, such as the free flow market cap, we have a balance between the market cap and also the tradability, and also to avoid the concentration risk. 10% cap is applied to the single stock, and also through the half-year rebalancing, the REITs with the large market cap and improved liquidity is expected to gain more weight and vice versa, which means the REITs with a smaller market cap and reduced liquidity, they will get a smaller weight or even be kicked out from the index. And now the index includes both the cyclical and defensive names, led by the industrial REITs and followed by the office, retail, and also the data center REITs. Because we have the largest and liquidity exposure, we are really sensitive to the market, the broad market movements, which means if the markets start to rebound, we will follow this very quickly. And as for the geographical revenue sources, the Singapore underlying projects accounts for 60%, and followed by the APAC and also the global exposures. So this is really meaningful to the individual investors because individual investors can simply use the SGX listed REITs to access the international REITs exposure, but your withholding tax is still zero because you are trading the S-REITs or S-REITs ETF, but your underlying growth opportunities is still across the world. And the market cap and liquidity screening also led to our ETF's bias to the large cap S-REITs. For example, as end of June, the top 10 holdings of our ETF index, they account for 85% weight. And with the largest security owner behind is being sovereigns like the Temasek, and also their original sponsors, and also the world's largest asset managers. This can also highlight their liquidity and also highlight their the defensiveness of the whole portfolio. And as of yesterday, our CSOP IH S-REIT Leaders Index ETF, the SGD ticker is SRT, has already an AUM close to $100 million because here the number is as of end of June, and now it's already close to 100 million. So all the retail investors in Singapore can trade the SRT on the Singapore exchange starting from just 1 unit, or roughly SGD 73 cents. So the entry threshold is quite friendly. And additionally, even for individual investors, we have primary creation redemption options, which means investors can, in addition to the SGX trading, they can also create or redeem the shares for the SRT like a mutual fund. And the threshold is just 50,000 units or slightly below the SGD 37,000. So this, of course, originally this was designed for institutional investors, but based on this minimum starting size, it's actually also can be applied to the Singapore individual investors. So both routes, on exchange or through the fund creation, they are available at the Philips Securities channel. And if investor, particularly if investor would like to place more, the primary channel is more suitable because it won't be subject to the same spread on SGX. It can also provide more cost saving because we can treat the underlying S-REITs in the baskets with a much more competitive cost versus the investors direct trading on SGX. And the ETF's dividend frequency is semi-annually, and our next ex-dividend date is next Monday, which means any existing holdings or new purchases if you can hold them by end of this week, you can receive the dividend. And the indicative annualized dividend yield this round it's 6.3%, and half-year payment is around at 3.1%. And in addition to the yield, the capital gain potential remains. For example, in the first half of this year, the SRT delivered total return at around 3.6%. But if we see another round of the cut or the easing signals, there is still a great potential for the more upside, which can be ranged from 5 to 10% for the rest of the year. And lastly, in my presentation, I just want to highlight that since our SRT inception almost 3.5 years ago, we have a very decent and also a stable average dividend yield at around 6%. So even regardless of the price move in the future, maybe up or down, we will continue to deliver these stable yields to our investors. So that's all for my lunchtime sharing. But we would like to leave more time for the Q&A session. Thanks.
All right, thank you, Bruce. So we have a couple of questions. The US dollar investment in the CSOC ETF distribution, is it in Sing dollars or is it in US dollar?
Yeah, that's a very good question. Actually, if you look back this page, we have both SRT counter in SGD and SRU counter in USD, which means if you trade on exchange, you can choose SGD and you can also choose the USD. But when we distribute the dividend to our investors, they are all in Sing dollar, regardless of our traded currencies.
All right. Okay, next question. As Singapore interest rate is really dropping as the anticipation for the possible Fed rate cuts are being priced in. In the event that the Fed does cut rates eventually, would there be a further drop in the interest rate which will benefit the S-REITs?
Yeah, that's for sure. Because to some extent, the MS, at least in recent 2 or 3 years, they are still following this the Fed move. But this time, what was different is that their easing move or their interest rate is getting lower ahead of the Fed cut. And also, as I mentioned in my presentation, even without any further cuts, the S-REITs, their borrowing cost has already peaked even in third quarter last year. So that's why we have already seen the support from a lower interest rate in Singapore. But investor may follow by another question is that why it didn't rally that much. I think, as I mentioned at the beginning of this slide, is because of these fundamental challenges. But overall speaking, as compared to the stocks, the S-REITs are still relatively has a stable fundamental and earnings flow, thanks to their stable rental growth and also these relatively long earnings, the rental contract. So that's why we think if there's another round of cut or from the Fed, it may have even how to say even more obvious impact or positive impact to the S-REITs as compared to the fundamental change.
Okay, next question. What's the benchmark of this ETF and what's the performance been so far?
Oh, as I mentioned here, the benchmark is the SGX IHS REITs Leaders Index ETF. It's a SGX issued index. It's I think our the unique feature of this index is that we have the transparency and also the liquidity. So we are really we can easily capture these the broad market move of the REITs of the S-REITs market, but our timing but the timing of our portfolio our portfolio inception is November 2021. So that's why you still see a negative annualized return since our inception. But overall speaking, since the inception of this index, actually their annualized return in Sing dollar is around 4.5% per annum, which means it has a very stable total return stream since the year 2010. And also, if you look at long-term performance series, actually, you can always argue that the price volatility can impact your capital gain, capital loss in the short term, but over time is actually mainly driven by the compounding of these stable dividend yield as shown here, which means long term in the long term your total return is still mainly sourced from your 5-6% dividend received over time.
Right. Okay. So someone's also asking how about the DPU. Will it drop as well with the anticipated interest rate cuts?
I think there are two edge of this sword about DPU. I think interest cut itself may not necessarily means the DPU drop because the DPU may also subject to your your revenue versus your cost. So all else equal, if you let's say your rental income remain constant, but your cost is getting lower because of the rates cut, then it should translate into a DPU increase instead of the DPU decrease, and that's exactly what we are talking about today. Because rental growth on average are still maybe middle single digit, but if the cost continue to get lower, then we should still continue to see a DPU rebound instead of the DPU drop.
Right. Okay. So, with the S-REIT at a historical low PB ratio right now, what are the possible factors that would negatively impact the S-REIT stock prices?
Yeah, as I mentioned, it seems we're ahead of the another round of the rate cuts, which means we are still constructive of these potential opportunities. But as I mentioned, we also need the fundamental to recover. That's because over the past several 2-3 quarters, we still see some fundamental challenges, particularly for those cyclical names such as the Grade B offices, and also some the industrial risk with such as the business parks as well as some small factories. So if and even hotel rates because the previous surge in terms of the room rates, the revenge spending the revenge spending effect is have already behind us. So all those fundamental challenges they are still in place. So which could impact your upside potential of the S rates.
Okay, so someone is saying that the Fed has cut the interest rate for a couple of times last year. Did the S-REIT's performance actually reflect this rate cut in terms of performance?
Yeah, I think this is a quite good question. I think they did reflect these kind of rate cut expectations, particularly ahead of the actual rate cut which started. So which means once the rate cut started, it may be too late to place the raise investment. But it's the good time is always that when the rate cut expectations going to emerge instead of when the actual rate cut is going to start. So that's why we should pay attention to the expectation side instead of the actual starting date timing. Yeah.
Right. Okay. Also for the DC REIT counters, would there be future possible introduction into the S-REIT ETF other than the existing capital counters?
Yeah, I totally agree. Because again, our index it's a rule-based index, which means only the rates with the uh, large minimum size and a large minimum trading volume, they will be eligible for our index, and only they can beat the other REITs market cap or their liquidity. They can rank their rating can be ranked in the top in the top ranking. But of course, we will cap it at 10%. So I think the data center REITs or at least in the Asia Pacific region, their opportunities is still from the AI boom or particularly the technology boom, which means this kind of boom, the first batch of the beneficiaries, they are still from those upstream the chip producers or the calculation power providers. So these request a lot of um, requirements or demand for these data centers in the region. So this is a bit different from the US because US their supply is quite sufficient for now. But for APAC, I think there's still some room to go.
Okay, I think someone also asked the DPU, is it paid out from the capital of the fund itself?
Yeah, good question. I think our principle is that we will all the dividend we received, underlying dividend received, we will not withhold them. We will pay out all of our underlying dividend yield, but we'll continue to compare our yield received versus the index indicative yield. For example, if our portfolio yield is higher the most recent example is that if our underlying portfolio yield is higher than 6.3%, then we will pay our portfolio yield. For example, is 6.4%. But if our underlying received dividend yield is 6.2 or 6.1%, we will try to be in line with the index yield to make sure what you see is what you receive. So to answer your question is that we will most of our dividend payment is from our underlying dividend payment, but we will still pay a small amount out of capital to make sure your dividend yield is in line with our benchmark.
All right, thank you, Bruce. Okay, I think we have 2 more questions to go. Would you say that the negative performance of the SRT/SRU has got to do with the year of inception? Other ETF may have positive performance, but could it be due to earlier launch of the ETF?
Yeah, if we solely talk about the REITs portfolios or REITs ETF portfolio in Singapore, yes, that unfortunately this is the case because our launch is around 3.5 years ago. We launched this product right behind the Fed most aggressive hikes over the past 40 years. So, but even with these most aggressive hikes cycles, if you can see this page, since the inception annualized return is not that bad, which means they're still this in turn highlights they are really defensive and their total return. Of course, ideally, if your timing is right, you can achieve a great capital gain. But even you incept your product before this Fed hike cycle in late 2021, thanks to this continuing dividend payment, your total return can still pay back over time, which means that you can still expect a very stable dividend or total return in the future. But again, since we are still at a very low level of the REIT valuation, in addition to the dividend, that we can still expect more capital gain from the current low.
All right, thank you, Bruce. So we have the last question. So with inflation going up in the US, chances of interest to stay high for longer in the US, would it affect the Singapore interest rate and its impact on S-REIT? I think this was mentioned earlier, but maybe Bruce, you want to touch on it again?
Yeah, I think in the past I would say yes, because in recent years the MAS their interest rate they follows the US rates very closely, and also, but of course there's a negative yield spread. But for now, even as I mentioned, even the US is not going to cut soon solely because of the inflation concern. It may not necessarily impact the Singapore REITs, because Singapore REITs, their major funding source still from the SGD instead of the US dollar. And as we mentioned at the very beginning, the SGD, the funding rates are already going lower a lot. So, and also the Singapore inflation, they're also going down a lot. So to some extent, the Singapore interest rate and Singapore inflation already decoupled versus the US interest rate and US inflation. So which means even without the further Fed cut, because of the peak of the Singapore borrowing cost, and also because of the peak of the inflation in Singapore. So from this perspective, we're still constructive on S-REITs.
Okay, I think we have come to the
I
end of
saw
the
another
webinar.
question.
Yeah,
when will the fund trigger the cap of the 6% of the fee? Yeah, it depends. I don't have a very exact number, but I would say if the fund size is getting very small, it will trigger the 60 bips cap of the of this fee structure. But what I want to highlight that even we trigger this 0.6% fee cap, we will not increase our fees for this portfolio. And also, if you look at this performance table, you can see that over time, if our gross of fee performance is nearly 60 bips, which means we have a fees in our ETF, an average ETF has, but we try to through our portfolio positioning, we try to outperform outperform the benchmark by a little bit to overwhelm or to cover these fees. So which means you can almost see our portfolio ETF performance, which is quite close to our benchmark even after the fees.
All right, thank you, Bruce. Okay, I think we have come to the end of the webinar. Thanks everyone for joining in. So for any further questions, you may drop an email to us. Our email address is marineparade@phillip.com.sg. We have left the email address in the checkbox below. So if you also want a copy of the recordings of the webinar, please drop us an email as well, and we will send it back to you. All right. So with that, thank you very much, Bruce, for joining today's webinar. And thanks everyone for joining. All right. So we wish everyone a good week ahead. Thank you, everyone.
Thank you very much.